Hello everyone, you're very welcome back to the channel. Today, we're talking about 8 costs of zero commission brokers. Commission-free investing has become the norm for online brokerage platforms. In Europe, online brokers like Trading 212, Trade Republic, DEGIRO, and BUX Zero all offer zero commission investing as a service to their customers. In the US, you have the likes of M1 Finance, Webull, TD Ameritrade, among many others doing the exact same thing. We can all agree that the emergence of zero commission investing has been a positive development in the investing world. This is especially true for your average retail investor who may only be investing €100 per month. If they were charged a large fixed commission for making those investments, it would hardly be worth their while. So the fact that they can invest commission free is great. However, many investors make the mistake of thinking that zero commission is the same thing as zero cost. Just because an online broker offers zero commission investing does not mean that there are no costs associated with investing via that broker. There are. When you're comparing one zero commission broker to another, you shouldn't make your decision based solely on the different features and products that the brokers have to offer. You must also compare the brokers on the basis of their costs. How much is it going to cost you to invest using one broker versus another? To answer that question, you need to be very clear on your intentions. What will you be investing in? How often will you invest? Will you invest using available funds or on margin? How will you transfer money to your brokerage account? As you'll see, the answers to these questions will influence your cost of investing on different brokerage platforms. Therefore, the name of the game isn't always finding the outright lowest cost broker, it's finding the broker that can facilitate your investing intentions at the lowest cost. Sometimes that will be the same broker, sometimes it won't. With that being said, let's talk about 8 costs of zero commission brokers. The first section of this video will deal with costs that explicitly arise from fees charged by the broker. The second section will deal with costs that arise as a result of the characteristics of a given brokerage platform, and the final section will deal with costs that are largely outside of the broker's control. Section 1. Costs that explicitly arise from fees charged by the broker. Number 1. Deposit fees. Deposit fees are fees that are charged on the deposits that you make to your brokerage account. For example, if a broker charges a 1% deposit fee and you transfer €1,000 to your brokerage account, then the broker would charge a deposit fee of €10. Deposit fees are highly unattractive to investors because you're paying money for the simple luxury of transferring money to your brokerage account. Fortunately, deposit fees are uncommon, and where they do exist, they're normally 100% avoidable. Deposit fees usually crop up where the broker allows you to transfer money to your brokerage account using credit cards, debit cards, Apple Pay, and Google Pay. For example, for European investors, both Trading 212 and Trade Republic allow you to transfer money to your account using these methods. With Trade Republic, you'll pay a 0.7% or 70 basis points fee every time you transfer money to your account using these methods. That's a €7 fee for every €1,000 transferred. Trading 212 also charges a 0.7% fee. However, the first €2,000 transferred to your account via these methods is free of charge. However, these deposit fees are 100% avoidable on both platforms provided you use bank transfers to send money to your account. This is a slower process, but over the long term, it will prove to be far less costly. Number 2, foreign exchange fees. Many European investors set up a brokerage account with the intention of investing in companies that are traded on American stock exchanges like the New York Stock Exchange and the Nasdaq. These stocks, as you might expect, are quoted in dollars. In other words, the price of Apple stock on the New York Stock Exchange is quoted in dollars, not euros or pounds. So when you use your euros or pounds or any home currency other than the US dollar to buy stocks that are quoted in US dollars, it's necessary to convert your home currency into dollars. The reverse is true when you want to sell your US stocks. The value of your investment, which is quoted in dollars, must be converted back into your home currency before the cash hits your brokerage account. Most online brokers handle this process for you, and all of the necessary currency exchanges are executed automatically. However, more often than not, there is a fee associated with this service. If you're someone who is intending to invest in financial instruments that are quoted in a currency that is different to your home currency, you should select a broker with low FX fees. Let me give you some examples of FX fees charged by European brokers. BUX Zero and DEGIRO charge a foreign currency conversion fee of 0.25%. So you would expect a fee of €2.50 for every €1,000 invested in non-euro denominated stocks. Trading 212 charges a 0.15% FX fee, while Trade Republic charges no FX fee at all. There is a caveat to Trade Republic not having an FX fee, which we'll talk about later in the video. Clearly, if you plan on frequently investing in financial instruments that aren't denominated in your home currency, then FX fees should be a top concern. Remember, all of this is before you consider the inherent currency risk associated with investing in financial instruments that aren't denominated in your home currency. Number 3, transaction and service fees. Transaction and service fees are the fees you pay for using different services on a given brokerage platform. Different brokers charge fees for different services. Some brokers might charge a fee for a particular service, while another broker who provides an identical service might charge no fee, and vice versa. It's not possible to bundle all of these fees into one singular fee that you should look out for, because honestly, brokers can charge fees for all sorts of things. For example, DEGIRO charges a €2.50 annual connectivity fee for every stock exchange that you utilize in a given year that isn't your home stock exchange. That's a really unique fee that you wouldn't see with other brokers. Likewise, different brokers will charge different fees for investing in different products. For example, while Trade Republic is a zero commission broker, they charge a flat €1 fee anytime you invest. The exception is with their savings plan functionality, which is essentially automated investing. Compare that to DEGIRO, where depending on the product you're buying, you can go from paying 0 commissions and 0 fees to paying 0 commissions and a flat €1 fee to paying a commission and a flat €1 fee. That's on top of any FX fees that may be charged. You can start to see why it's important to define your intentions as an investor. If you don't know how you intend on using the platform to invest, it can be very difficult to accurately assess the true cost of investing. That brings us on to section 2, costs that arise as a result of the characteristics of a given brokerage platform. Number 1, opportunity cost. When you transfer money to your brokerage account, that money is typically held with a bank or banks that the broker is partnered with. For example, Trade Republic is partnered with Solaris, Citibank, JP Morgan, and Deutsche Bank. Your cash deposits are held with these banks before they're invested. Now, normally, if you were to leave cash on deposit with a traditional bank like AIB, BOI, or PTSB here in Ireland, you'd receive a very small investment return in the form of deposit interest. Logically then, you'd expect to receive deposit interest on your uninvested cash that's held with your broker and their partner banks. Indeed, Trade Republic offers its customers 2% deposit interest on their uninvested cash, which is very good, but this isn't common practice. Most brokers offer 0% interest on uninvested customer deposits. That means there's an opportunity cost associated with transferring cash to most brokerage accounts, especially if the intention is for that cash to sit idle. Consider a situation where you're receiving dividends from your investments. Is it your intention to immediately reinvest dividends, or is it possible that they could be left sitting idle for a period of time? If it's the latter, then you need to take account of the opportunity cost associated with choosing a broker that pays 0% interest on uninvested deposits. Number 2, payment for order flow, better known as PFOF. Earlier I mentioned that there was a caveat to Trade Republic not having an FX fee. That caveat is PFOF. To understand PFOF, you need to understand how brokerage platforms process customer orders. Without going into too much detail, when a broker like Trade Republic opts to use PFOF, that means the broker has decided to route some or all of its customer orders to one single market maker. The market maker is a firm separate to the broker who is effectively a wholesale buyer and seller of stocks. So whenever you buy a stock using a brokerage platform, you're very likely buying from a market maker, and the market maker is making a very small profit on each trade. The incentive to use PFOF is that the market maker gets a steady stream of customers from the broker, and the broker gets a small slice of the profit made by the market maker. The criticism of PFOF is that it has the potential to lead to less favorable outcomes for investors, namely a situation where an investor isn't offered the best available price for a particular investment because the broker has opted to go with one single market maker. That is a real cost to you, the investor. The reason why Trade Republic has no FX fee is because all orders are routed through the Lang & Schwartz exchange, where all stocks are quoted in euros. The question you have to ask when using a broker that uses PFOF is whether or not that broker is committed to your best interests. Trade Republic commissioned a research study which highlighted the benefits of its PFOF model. Trade Republic's use of PFOF actually saves money for investors, and that finding is consistent with an SEC report that outlined the potential benefits of PFOF if it was used correctly. Whether or not PFOF is used correctly will depend on the broker. Number 3, securities lending. Many investors don't realize that their broker is lending out their stocks to other investors, namely short sellers. This is what's known as securities lending, and many brokers do this in order to earn additional revenue for their business. Now, while this doesn't come at a direct monetary cost to you, the investor, it definitely adds an additional risk factor which could result in a future monetary cost if that risk was to come to fruition. Most brokers who operate securities lending ensure that the only way that you could lose money from their engagement in the practice is if A, the shares aren't returned by the borrower as a result of their bankruptcy, and B, your broker simultaneously goes bankrupt alongside the borrower. Even if that happened, you would still receive the cash or stock collateral that the borrower is required to post when borrowing your shares. So your loss will be limited to any difference between the value of the stocks lost and the collateral posted. The questions you want to answer are A, does my broker engage in securities lending? And if so, B, what protections are in place for my investments? Investor protections are always an important consideration to take on board when choosing a broker. Check out the video popping up on screen after this one if you want to learn more about specific investor protections and what to look out for. That brings us on to the final section, costs that are largely outside of the broker's control. Number 1, bid-ask spread. Bid-ask spread is simply the difference between the bid price and the ask price of a given investment. When you buy a stock, you pay the asking price, and when you sell a stock, you receive the bidding price. The difference between the two is a real cost to investors. Why? Well, let's say a stock has a current bid price of €9 and a current ask price of €10. If you were to buy that stock and immediately sell it, you'd make a loss of €1, plus whatever other fees you incurred to make the trade. That's because you're buying the stock for €10 and immediately selling it for €9. The difference of €1 is the bid-ask spread, and this difference is the potential profit that the market maker is making on the transaction. The primary factor which influences the size of the spread is liquidity, i.e. the ease at which the investment can be converted back into cash. The liquidity of an investment is influenced by supply and demand. For example, an S&P 500 company stock will have much smaller spreads than a company that's listed on the Indonesian stock exchange. Bottom line, the broker has no control over bid-ask spreads, but it represents a real cost for investors. One could argue that brokers who use a PFOF model have some influence over the spreads that customers are paying, given that the broker has made a decision as to which market maker should be used. Last but not least, we have taxes and other costs. Naturally, different countries have different rules as to how charges should be levied on the activity of investing in companies that are established in their jurisdiction. One such charge is stamp duty. If you buy UK shares, you'll have to pay a 0.5% stamp duty tax. If you buy Irish shares, you'll have to pay a 1% stamp duty tax. The French government charges a 0.3% financial transactions tax when buying certain French shares, and a similar tax exists for Italian shares. Separately, there's charges levied by FINRA and the SEC when selling US shares. If you transact more than £10,000 worth of UK shares in one go, there's a levy of £1. There are lots of these finicky fees that need to be considered, and in many cases, they're not insignificant, and they should definitely influence your intentions as an investor. So that's a cost of zero commission brokers. It's very important to note that fees change over time. Just because one broker offers attractive fees today does not mean that it will continue to do so tomorrow. New brokers are constantly entering the market, and with that comes potentially better opportunities. It's your responsibility to ensure that the broker that you've chosen is and continues to be the best choice for you. With that being said, if you want to try out a new broker like Trading 212, Trade Republic, or DEGIRO, you can do so using the links in the video description. Using these links supports me as a creator and lets me know that you found this video to be useful. Before you go, you might be interested in this next video, which shows you how to automate your investments into the stock market using Trading 212 and Trade Republic. Thanks very much for watching, and I'll see you soon.